Right now, the entire cryptocurrency exchange market is rapidly collapsing under immense commercial pressure and tightening global regulations. In September 2026, legacy platform BitMEX announced it would close its trading operations entirely. Shortly after, BitMart began winding down all of its trading, citing the hostile market conditions. Even Binance, the planet's largest exchange, had to stop serving clients in the European Union after failing to secure authorization under the bloc's new regulatory framework. With major players disappearing from the market, the survival of an exchange now depends entirely on its ability to satisfy strict public-grade licensing standards. Faced with a target on their backs, struggling exchanges have three standard options: downsize, relocate, or liquidate entirely. But South Korea's largest exchange, Bithumb, is taking a counterintuitive route, pushing into the most heavily regulated environment possible. They are actively preparing for an initial public offering in 2028. Subjecting yourself to the intensely harsh scrutiny of global financial regulators seems like a complete and utter death wish right now. But for Bithumb, it is a calculated survival mechanism. Public investors expect absolute proof that customer assets and corporate funds are secure. They demand flawless internal controls, an area where crypto exchanges historically fail. Bithumb brings its own heavy baggage to this process. Recently, a severe governance failure resulted in a mistaken Bitcoin transfer worth roughly $40 billion. The incident was so severe that Chief Executive Lee Jae-won had to publicly acknowledge major shortcomings in the company's internal safeguards. You cannot ask traditional markets for capital when your foundational operations are that fragile. To fix this, Bithumb has initiated a grueling 2-year internal restructuring program, aiming to complete its operational overhaul by the end of 2026. Their first major fix is physically splitting the business, separating the core trading exchange from asset management operations. This structural divide clarifies responsibilities, making internal governance simpler for auditors to verify. It directly neutralizes hidden conflicts of interest that have destroyed other crypto platforms. Next, they are adopting Korean International Financial Reporting Standards, a strict set of accounting rules, and expanding their regular disclosures to explicitly detail their digital asset holdings. By physically separating assets and adopting international accounting standards, Bithumb is removing the specific structural flaws that triggered the collapse of its competitors. This timeline plots Bithumb's chronological roadmap. They must complete internal control upgrades in 2026, submit an application for listing review in 2027, and execute the IPO in 2028. They are weighing their listing menu, choosing between Seoul's Kosdaq and the Nasdaq in New York. The sheer volume of legal and accounting preparation required over this 3-year stretch illustrates how demanding traditional public market entry is compared to raising private crypto funds. The outcome of this IPO attempt will determine if a cryptocurrency exchange can survive the transition into a regulated financial institution. If Bithumb successfully navigates this transition, they will prove a crypto exchange can operate with the accountability and transparency of a legacy Wall Street bank. But if they fail, or if regulators reject their sanitized structure, it suggests the underlying operations of the crypto industry remain too toxic for public markets.